Hi, everyone. Thank you for joining us today. My name is Marcia Butler. I'm the webinar director here at Advice Chaser, and we want to welcome you again. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. A couple of notes to our attendees. You are on mute, but we do encourage you to ask questions using the chat box. And let me see if I can turn that on so that you'll be able to chat with us. There we go. I just turned that on. The presenter will answer those queries during or after the presentation today as appropriate. And if you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information and we'll make sure someone reaches out to you after today's event to address that. Again, we want this experience to be as educational as possible. So please don't hesitate to ask for clarification or expansion of the material. We'd be happy to help. I'd love to introduce you to our presenter today. David Shear is a certified financial planner and chartered financial consultant that works at Crim Associates in Paramus as a financial advisor. David specializes in wealth management, estate planning, and insurance planning for professionals, executives, successful business owners, and retirees. His approach incorporates a comprehensive planning process in order to advise clients in making well-informed decisions that are consistent with their long-term objectives. David's background spans over several decades, including serving as a managing director at Stifel Nicholas, as well as a vice president at Goldman Sachs in the company's respective institutional equity departments. His educational background includes a master's of business administration with concentrations in accounting and finance with the University of Chicago Booth School of Business, as well as a Bachelor of Arts with a major in economics from the University of Rochester. Well, David, we're excited to have you here. I know that we've had a lot of fun preparing for this. It's really a good topic, and I'm really excited to have you here. So let's go ahead and turn the time over to you, and I believe you're going to share your screen now.
Yes, thank you, Marcia, and welcome everyone this afternoon. Just give me 1 second to be able to actually share my screen and pull up the presentation.
And I can see it just fine.
Okay, I'm just going to put it, there we go. So welcome again, and welcome to our webinar on Retirement Planning 101. There's certainly a broad potpourri of topics we're going to touch on today. We could spend over an hour on each topic individually. Obviously, we can't go quite that deep today, but we're hoping that we can at least kind of touch on a couple things that get you thinking and at least gives you a couple nuggets to take away as you plan for your retirement. So before we get going, unlike Advice Chaser, we actually do financial planning for a living. So our compliance department actually makes us put up this disclaimer. And all this basically says is that this webinar is for educational purposes only. So when we start on the topic of retirement planning, the first thing we like to say to anybody is when you're planning for retirement, you want to expect the unexpected. And that's a little bit of a mindset as much as it is an actual planning tool, that when you start getting into your retirement years, and even before that, things happen in life that you can't always expect. And when you're deep into retirement, unlike in the years before that, you don't always have the flexibility that you might have when you're younger and working to kind of pivot, the way you really can't pivot in retirement. And when we talk about problems in retirement, most of the times we're referring to problems in income where you have gaps, and you have these shortfalls. And what we want to try to do is avoid these shortfalls. Now, another important topic we want to address in this webinar later on is the concept within retirement is there's really two phases. The first phase is what we call the accumulation phase. And that's the phase that most of us are familiar with, where we're basically accumulating assets through most of our careers, whether it be a 401k or an IRA or even brokerage accounts or other vehicles. But we're not thinking about taking money out of those vehicles because we don't need to. As we start getting into retirement, for most of us, there's some of us who are fortunate not to have this, but for most of us, when we get to that retirement, we're using that nest egg to basically distribute to help supplement our income. So that's what we call the distribution phase. So it's important to understand that money acts differently in the accumulation phase and the distribution phase. And we'll talk a little bit more about that later on in the webinar, but it's important to understand that distinction. Now, what are some of the gaps we're talking about? Well, one of the most obvious ones is when you have inflation and it inflates your expenses faster than your income's growing, that can potentially create a gap in real terms between your income and your expenses. But there's other things too. I mean, you have circumstances that happen in life. Certainly at the top of the list is death. And what I mean by death more than anything is an unexpected death. Someone who might be an income provider, prematurely dies before you expect it, which, can affect your income plan, particularly as it relates to something like Social Security. Health issues. You have an unexpected health issue that you weren't planning on. And these things happen, especially as you get older. Certainly, financial market conditions can affect that. And one of the things we'll talk about a little bit later on is volatility in markets affect you more when you're in or near retirement than it might say when you're younger. Certainly, family situations. I don't know if there's anybody on this webinar who might have a child in their late 20s or 30s who's still living at home, who maybe that wasn't planned on originally. Or you're fortunate enough to have a parent who's still alive well into their 90s, and there's some costs related to that you weren't expecting. So there's all kinds of things that can happen that maybe you weren't planning on. So those are the kinds of things we're talking about when we say, expect the unexpected. Now, I just want to take a minute to talk about Medicare, and I'll be the first to admit I'm not a Medicare expert, but certainly when we're talking about financial planning, it is an important topic to at least touch upon. And I just want to say a couple things about Medicare that I just want to pass along that are important. So, for most of you who are have not started collecting Medicare yet. And there might be some of you on this webinar who are, but for those of you who have not, Medicare works this way. So when you hit 65, you have something called Medicare Part A, which covers your basic hospital stays and things like that. You have Medicare Part B that covers your basic doctor's appointments and things like that. But for those of us who are used to being on, comprehensive medical plans, through your company or things like that. Basic Medicare itself, when you're talking about Part A and Part B, aren't necessarily as comprehensive as you might have expected. So there might be gaps. For example, Medicare doesn't usually cover dental. It doesn't cover vision. If you have special, treatments, or need certain specialty type things, Medicare might not cover everything you want it to. So if you're looking for broader coverage, one of the things you might want to explore is what we call a Medicare supplement plan. And there's a couple different kinds of them. One of the most well-known is something called a Medicare Advantage plan, where you go to a private company, and what they will do is they'll basically not only pick up Medicare, but they'll pick up some of the gaps in Medicare, so it will be a little bit more comprehensive. Now, for anybody who's kind of watches TV a lot, before the Medicare enrollment period, a lot of times these Medicare insurance companies who are providing these Medicare Advantage plans will advertise. So, you'll notice those things. And the one thing I will say, to be a little careful, cheaper isn't always better. So, because sometimes what will happen is some of these insurance companies will offer very cheap rates, but they'll have higher deductibles. Their coverage won't be as broad. So when exploring these types of plans, make sure you understand the coverage you're getting, because what's most important is the cost of ownership over the balance of your lifetime, not necessarily the cost of the premium itself. Now, the other type of supplement is something called a Medigap plan. Same basic idea as a Medicare supplement. Medigap strictly fills in the gaps between basic Medicare and the things that generally aren't covered. So what we would recommend for anybody who's looking at kind of figure out what's the best Medicare coverage for them, we would suggest reaching out to somebody who is a Medicare insurance broker who actually specializes in these plans. And there are people who specialize just in selling Medicare Advantage and Medigap plans. Most of them are very knowledgeable, and they can help guide you through what might be best for you. Now, the last bullet point, it says an insurance broker is not a fiduciary. We're not going to really talk a lot about that today, but it's important to understand, we get a lot of questions. What does it mean to be a fiduciary? And that means that, we have a responsibility to act in somebody's best interest. Most Medicare insurance brokers are not fiduciaries. That doesn't make them bad people. That doesn't mean you shouldn't use them. All it means is they're not a fiduciary. So you should just be aware of that when you're talking to them. So that's the only reason I bring that up. Now, while we're on the topic of healthcare, a very big topic in healthcare is long-term care. And long-term care is different than, what would fall under Medicare. Medicare, usually when we think about Medicare and Medicare coverage, it's for when you have a medical problem. Long-term care relates to not necessarily a sickness, but as you're aging and you have the inability to do certain activities of daily living, things such as, need assistance going to the bathroom, need assistance dressing, need assistance getting out of a chair. Those kinds of things are what we refer to when we refer to long-term care. And it's funny because, when I was growing up and I thought about long-term care, usually the first thing that comes to mind is a nursing home. And yes, nursing homes are part of what we talk about when we talk about long-term care, the cost of going into a nursing home. Today, it's much more broader than just a nursing home. It can encompass home therapy. It can encompass maybe certain types of physical therapy they require. It can, assisted living. So they're all different types of things that can assist you with the activities of daily living that fall into the category of long-term care today. Now, I want to throw this slide up. Now, this slide's a little dated. This is from 2019, but it goes through the average costs for some of the, the most common areas within long-term care. Now, what's interesting, and my office is in Paramus, New Jersey, which is right outside of New York City. So, the costs where we live, if anybody's on this webinar or lives in a major metropolitan area and is familiar with any of this stuff, will realize that the cost actually can be a lot more than these national averages. For example, that 90 to 100,000 in northern New Jersey could be more like 150,000. So they can be very, very expensive. And that's the point. Long-term care can get very expensive very quickly, depending on what you need. Now, the other thing to understand, unfortunately, most of us statistically will probably need some sort of long-term care between now and the time they die. So, just to read off the slide here, just so everyone appreciates these numbers, basically just under 70% of Americans who live past the age of 65, I believe, is being blocked, but I believe it's 65, are going to need long-term care at some point in their lives. And certainly the probability of being disabled is very high as well. So that's the bad news. Before I talk about some of the different ways we deal with these costs, I just want to put that number in perspective because I think it's important to kind of put that number in perspective. When we talk about 70% of people statistically will need long-term care, unfortunately, about 20% of the people who need long-term care assistance die within the first 6 months that they're living. The other thing to keep in mind is another 20% pass away within 1 year, and another 40% pass away within the next 3 years. So that basically says that roughly 70 to 80% of the people who need long-term care die within 4 to 5 years. So there's a tail of people, that 20, 30% tail that could need long-term care insurance for a very long time. Matter of fact, I had a great aunt who had a mother who had a stroke in her late 60s and needed long-term care for over 10 years. I mean, so these things happen, unfortunately. But statistically, that's in the minority. So just to keep in that in mind. Now, the way we think about this is that there's different ways to deal with long-term care. One way is to just self-insure, right? You're going to basically take that risk that you're going to pay any long-term care costs when they come. And to be honest with you, as a financial advisor, I have a decent number of clients who do self-insure. And that's not necessarily a bad thing. But what I will tell you, anybody who's on this call, is if you're going to self-insure, you better have a good plan. You better understand how you're going to pay for long-term care if it happens, and don't just have your head in the sand. It's an important thing, and it can really cause a life-changing situation for you and your family if you don't have a plan on how to deal with it. So that's important. And the other thing to understand, there are, depending on your situation, there are things you can do using more sophisticated trust strategies and things like that. That's well outside the scope of this webinar. But there are options outside of just thinking about long-term care insurance. Now, while we're on the topic of long-term care insurance, that is absolutely an option when thinking how to pay for long-term care. Now, one of the things to understand about long-term care insurance is back 20 years ago, when most of the people on this call, their parents were buying long-term care when it first was available, insurance companies would sell you a long-term care policy and you'd pay a premium and you'd get a benefit if you qualified. And that benefit was uncapped. So as long as you needed long-term care, if you qualified, you could receive benefits. Unfortunately, those days for the most part are long gone. So when you buy a long-term care policy, it's usually capped. So what does that mean? So if I buy a standalone long-term care policy and say it's capped at $500,000, if I have a premium of say $4,000 a year, and then all of a sudden I need that long-term care, I can get a benefit up to $500,000 a year. So based on that chart that I showed you last slide, if I was in a situation where I needed long-term care for multiple years, 4, 5, 6 years, at some point I'd be capped out. Now, conversely, in a standard long-term care policy, if you don't use the benefits, you lose them. So we call it, it's kind of a use it or lose it. So what that means is, if I have a long-term care policy, I use the benefits because I qualify and I'm $100,000 in and I have a $500,000 cap and then I pass. What happens to the $400,000 that I didn't use? I lose it. So that's what we mean by use it or lose it. If I don't ever use it, I lose it. Now, one of the things we look at, and one of the things that is an option that you should be aware of, is something called a 7702 option, or it's basically a combination life insurance with long-term care rider. So what that means is you can buy a life insurance policy that has a long-term care rider, and you can use that rider for long-term care the same way you could use a standalone. So as an example, similar example, I have a 7702 with a $500,000 benefit. So if it has a death benefit of $500,000, I can use that death benefit to pull forward to cover long-term care expenses up to $500,000. So in that same example I just used before, if I'm $100,000 in on long-term care expenses, and then I pass, that $400,000, instead of losing it, it goes to my beneficiaries. So one of the benefits of something like that is if something happens to you, your estate or your beneficiaries get the balance of it. So it's not necessarily use it or lose it. Now, like all these things, there's pluses and minuses, right? So it's really what's right for your situation. So really the only point of bringing this up is for awareness. Now on the next slide, again, this just for an awareness point of view, you should know, for example, if you don't qualify for a life insurance policy, or it doesn't make sense, some annuities have combination long-term care features as well. Again, not saying they're right or they're wrong. It's just really for more awareness purposes. There are certain annuities out there where you can actually pull some of the assets, and they have tax benefits if you use them for qualified long-term care expenses. So Want to switch gears for a second and just discuss, well, what happens, when you die? This is really the topic of estate planning. And when we talk about estate planning, we're just going to spend a couple minutes talking about it. It can get very complicated very fast. But very simplistically, estate planning really comes down to two things. Number one, it comes down to when you pass, you want your assets to go efficiently to the people who you want them to go to. So to make sure things get passed the way you intended them to pass in a timely manner. And the second thing it comes down to is having them pass in a tax efficient manner. That's really what estate planning is in a nutshell. Now, of course, it can get very complicated very fast, but that's really what it's about. Now, in today's webinar, I just wanted to talk about something we see a lot that's a very correctable problem that I just want to make sure that people understand. And it really comes down to understanding the concept of beneficiaries and making sure that you have your paperwork cleaned up as it relates to beneficiaries. And it's important to understand, if you have retirement accounts, 401ks, IRAs, can be annuities, things like that. Usually you have named beneficiaries. Now, if you have named beneficiaries, that does not pass through your estate when you pass. So it does not go through your will. It goes directly to your beneficiaries. So let me give you an example of what that means. So say you have a 401k and you've been working for 30 years with a particular employer. And when you started your 401k 30 years ago, your beneficiary was your wife. Say you fast forward the clock, 30 years, you got divorced 20 years ago, but you never changed the beneficiary on your 401k. And you have a will, so you think you're all set, and you pass. Guess what happens to the assets in your 401k? They don't go through your will. They go to your ex-wife. So it's very important to make sure that your beneficiaries are cleaned up on things like IRAs, life insurance policies, annuities, whatever you have. And you'd be surprised how often, we have clients, or newer clients particularly, because this is one of the things we try to do, where they come in and a lot of this stuff isn't cleaned up. So very important that it's cleaned up. And one of the things, we tell you is that, if you have a financial advisor, he should be reviewing this stuff with you. And if he's not, he should be. The other thing, and we just put the Supreme Court Kennedy case in here, because we just want to drive home the point that the concept of a beneficiary in an IRA passing, not passing through your will and going directly to a beneficiary has been challenged before. It's actually made it all the way up to the Supreme Court. And there's a case called the Kennedy case. And as you can see on the slide, it basically had a 9-0 ruling that held up the fact that the money in that case went to the beneficiary, not through your will. So very important. So we talked about what happens if you pass. For most of us, we're thinking less about that, but we're thinking more about how our money's going to live, or how our money's going to hold up for the rest of our lives. And fortunately and unfortunately, depending on how you look at it, we're all kind of living longer. And this is kind of results from the 2000 census. And, for the most part, listen, it's all good news, right? We're living longer. And if you pull up the 2020 census, the news gets better. So we're living longer. That's a good thing. If we go through, the numbers, we might have backed off a year or two from COVID, but for the most part, they're trending up. Okay. So, unfortunately, when we live longer, it increases the risk of running out of money. And one of the things we want to try to avoid is some of that stress of making sure we don't run out of money. And what are some of those problems besides, living longer than we think? We mentioned inflation, but, obviously health events, tax changes, inflation, which is obviously much more of a topic today than it was 3 years ago. But those are the kinds of things that can, unfortunately put us in a position we don't want to be in. Now, I want to talk about taxes for a second, because at the end of the day, when we're talking about whether it's retirement or non-retirement, at the end of the day, when we're talking about income, really what matters at the end of the day is how much we have in our pockets after we pay taxes, right? So I'm going to pull something up that most of you are very familiar with, but I just want to, and you'll see in a minute why I'm pulling this up. But for most people on this slide, most people in this webinar are well aware of the basic concept of paying taxes on our income, and that's referred to as ordinary income. And we have that tax schedule. We go through it with our accountants every year when we file our taxes. The other thing most of us are aware that when we are buying and selling capital assets outside of retirement accounts, we're usually not paying ordinary income, we're paying capital gains, right? And as most of you can see from this chart, most of you I'm sure are aware without this chart, is that capital gains are less than ordinary income. So why do I bring this up when it's so obvious? And I'm going to show you in a second why I wanted to highlight that. And highlight the fact that when you're taking money, out of your portfolios to supplement retirement, how you take it and where you take it matters. So you want to be thoughtful of where you take it from, because that can affect how much money is, quote unquote, in your pocket at the end of the day. So I'm going to run a very quick example so you can see exactly what I'm talking about. So in this example, we have a person, age 72. They have a taxable account value that is beginning at $200,000. They have a traditional IRA, which has a $500,000 value. And they have an average annualized return, we're going to assume, of 5%. We're also going to assume that they're in the 25% tax bracket. And we're going to assume an annual withdrawal of $25,000 a year. Okay, now given that scenario, we want to look at two different cases. Case number one is we withdraw all our money from the IRA and we don't touch our taxable account. Case number two, everything else is the same, except instead of withdrawing all our money from our IRA, we're going to take just our required minimum distribution from our IRA, but we're going to take the rest of it from our brokerage account. And we want to show you just that slight difference in how you withdraw your money in retirement can make a difference. So if we look on the left, That's example number one, or case number one, where we're withdrawing all of our income in retirement from our IRA. And what you'll notice is our IRA value, which is in the green, goes down, as you would expect, because we're withdrawing money out of it. We're not touching our brokerage account, so that goes up, right? So at the end of 25 years, we have 573,951. Now, if we go to case two, everything is exactly the same, except instead of taking all our money out of our IRA account, we're just taking our required minimum distribution, but we're taking the difference from our taxable account. Now, if you'll notice, when we do that in this example, we actually have more money, even though we're withdrawing the same amount. Why is that? Well, if you go think about the slide I showed you on taxes, ordinary income versus capital gains, when you're taking the withdrawal out in a tax efficient way, and you're taking some of the money out from your brokerage account, you're paying you're paying a lower tax rate. So there's a tax advantage to doing that. Plus, which we're not going to talk a lot about, but you also have what they call basis. You have a cost, so you're only paying taxes on the gains, and you're paying them at a lower rate. So the point is, and again, this is a very simplistic example. There's other factors to consider as well. But the point is that how you withdraw your money in retirement from your different accounts matters. So you want to be thoughtful of how you withdraw money when you're withdrawing money. Inflation. I'm just going to touch on it for a second. This graph obviously shows pretty much what everybody knows, which is inflation was really high in the 70s and the early 80s. Most of us on this call probably remember that. And then it was really low for a long time, and it started to tick up again. Now, why does that matter? Well, it matters for a couple of reasons, right? Number one, for the obvious reason that all of you are aware of, is when you have inflation, all you have to do is go to the supermarket to realize how it affects you, right? When you have a fixed income and it costs you more, when you go to the grocery store, in essence, you have less real income. So inflation lowers what we call real income. A couple other things to think about, which might be a little less obvious, is to the extent that your tax brackets are not indexed, you have something which potentially could cause what they call bracket creep. So if you're still working and your income is going up with inflation faster than it would have if inflation was lower, you can get bumped into a higher tax bracket than you thought. And you might be paying a little bit more taxes in an inflationary environment. That's what they call bracket creep. The other thing, which is particularly important, and again, most of you probably realize this, but because inflation can cause a lot of problems, and we're not going to go into all the reasons why inflation is bad, but to lower inflation, the biggest tool that is used is raising interest rates, right? And we raise interest rates, that's not good for financial markets. It's not good for the economy in a vacuum. So that's another cost of inflation, is the cost of fighting that inflation. So while we're on the topic of markets, I wanted to put this graph up here. And this shows the S&P 500 pretty much for the last 100 years. And what you can see is the gray areas represent a market cycle, and the purple areas represent a market cycle. So in this particular case, the gray areas would represent a bull market, purple bear market. So yeah, so you get the point. The point is that markets can have long cycles, which are bull markets followed by bear markets followed by bull markets, etc. This basically takes that same chart and adjusts it for inflation. And the point here is that when you adjust it for inflation, it can be potentially more painful in periods of bear markets in particular. Now, what I did on this chart is just kind of put in arrows where those would be good places if you thought you had enough assets to retire, right? Why? Because you're retiring and you're in a position where your assets are going to continue to go up and it's great, right? Now, conversely, sometimes we can get caught in just the opposite, right? Is what happens if we retire here? All those good years, they don't necessarily work as well. And that implied rate of return that we use to think that we were getting might not come to pass. So we need to kind of factor some of these things in when we're trying to increase our odds in retirement. And what I like to say to clients is, we want to have the odds of the house when we're thinking about walking into a casino, right? Now, if you think about it from an investing perspective, you can hit a 10-year period where the market's compounded average annual growth rate is 15%. You can also hit a period where it's 0, right? So, to use the casino analogy, right? You can be that guy at the blackjack table and you can look like the smart guy down a given night because you won a ton of money. But the reality is that unless you're a member of the MIT blackjack team, night in and night out, if you're sitting there, over time, you're not always going to win, right? But if you're the house, okay, and the way the odds are stacked in your favor, you might not win on a given night, but over time, there's a pretty good chance that you're going to come out ahead. So when we're thinking about an investment plan for retirement, listen, for most of us, we don't want to be necessarily the smartest guy in the room. We don't want to be, I told you so, and catch the very best, possible market environment. What we want to do is create a strategy where we're increasing the highest probability of winning over time. So that's what we want to do. And this is why, because if you don't pick the right cycle and you have the wrong strategy, it could work out not so well. And pointing to, well, I had a friend who retired in 2000 and he did great, isn't necessarily a reason to use his strategy, if his strategy was an aggressive one. So, and this, I just want to put up a couple numbers here that shows the fact that even though over very long periods of time, the market and equities have good returns. And by the way, for anybody on this call doesn't think I'm a big believer in equities, you're wrong. I'm a very big believer in equities. Over long periods of time, they're the best assets in class on the planet, or one of the best for most of us. But the point is that you got to make sure you fit it in properly within a retirement plan. They can be volatile. And you can see in this slide, from 2000 to 2022, even though you got over a 7% return, there's a lot of movement in the way. Now, I don't know if anyone here's ever heard of the lost decade, but the lost decade was from 2000 to 2010, where basically the S&P 500 was flat. Now, there are other markets and other asset classes that had positive returns during that time, but during that particular time, the S&P 500 was flat. One other thing that I just want to mention while we're talking about volatility, which is interesting, is that anybody who's kind of a student of the markets, I'm sure has heard that over a long period of time, the equity markets average between 9, 10, 11% over a long period of time. What's interesting is that over the last 100 years, if you look at the returns of the S&P 500 on a calendar year, the S&P 500 in a calendar year has only returned between 9 and 11%, 6 times in 100 years. So what that tells you is that even though you get a 9 to 10% return over a long period of time, there's a lot of volatility kind of, that you have to weather during that period. And we're going to talk about that in a little bit. But what's important to understand is that the older you get, the more susceptible you are to that volatility. The other thing I just wanted to point out is that it's important to understand a little bit the math of losses versus gains, because a lot of people don't understand this, because they don't think about it. It's not because people are stupid, but people don't think about it. So for example, if you have $100,000 and you're up 10%, you have $110,000, right? Now, $110,000 and you're down 10%, you have $99,000. So if you're up 10 and then down for 10, you're not even, right? Now, the other thing to understand is that if you lose 10, to get back to break even, you need to make 11. If you lose 15, you need 18% to get back. Now, I'm just going to put up a couple more numbers, but the easiest way to think about that, if you're not sure what I'm talking about, think about the lose 50, need 100% to gain. So what that means is, to make it really simplistic, if you have $100,000 and you lose 50%, you have $50,000, right? If you have $50,000, the next year to get back to 100, you don't need to make 50%, because 50% will only get you to 75,000. You need to make 100% to get back to break even. So it's just important to understand that math. Now, we say to clients often, especially as you're in a term, what's your income stream? Because when you're thinking about retirement, income is really very important, because you're generally not working anymore. So what are those sources of income? Now, I put up this slide here because when we think about our parents' generation, and again, this is a little bit of a generalization, but statistically, more people in our parents' generation worked for companies who had pensions. So when they got to retirement, for income, about a third of it on average was funded. When I say a third of retirement income was funded by Social Security. A third was funded from someone's pension, which means only about a third of income needs in retirement were really funded by an individual through personal savings. Now, fast forward today, what's happened? Most companies over the last 20 years, 25 years, have gotten rid of pensions. So, they're going to 401ks, 403bs, all those kinds of things. So now what's happened is that slice from Social Security still there, at least for now. And that pension slice is gone. Now, it's usually sitting somewhere in the form of a 401k. But again, the burden's on you to make sure that that money lasts throughout your lifetime. So there's more burden today to make sure that you are in a situation where you can make it through the rest of your life, you and your loved ones. So what we talk about, it's important to think about how do you kind of create income? And so one of the things you want to try to do is, in essence, create some sort of pension. Now, to be clear, when we're talking about a pension, a private pension, that's not a code name for an annuity, okay? Now, an annuity, for some people, listen, we're not even going to talk about annuities on this call. Some people love them, some people hate them. That may or may not be part of what we talk about as a private pension. What we mean by a private pension is basically creating something which improves your risk-adjusted returns, manages your volatility, so you're in a better position to kind of fund your retirement needs. That's simply it for the case of this presentation, for the purposes of this presentation. So I just want to spend a second on Social Security, and there's just a couple things I just want to point out. Number one, for those of you who aren't aware, and a lot of you probably are aware, but I think this is important for those of you who are unaware, that Social Security does have a website, ssa.gov, and you can log in. And if you don't if you've never done it, you can create an account, and it's very, very easy to go on here, create an account, and what you'll be able to see is what your projected benefits will be. So it's a very useful tool in planning for retirement. Now, for those of you who never have done it before, the only thing I will say, just as a little bit of a warning, it's not a big warning, but just a little tidbit, is that usually when we go on and we create logins with any kind of website, there's usually multi-factor authentication, and usually you can do that online, or you can usually verify through texts and things like that. With Social Security, usually, when I've been experienced with it, whenever they're doing that second factor of authentication, they physically will mail you a PIN code. So if you go to log in, it might take a week before you can actually see your account, because they'll probably mail you a PIN, and then you can log in. So that's just an FYI. Now, one of the things I like to point out in Social Security, now everybody knows that the earliest you can take benefits 62. You can take, depending on when you were born, we put 66 and a half on this slide. Anybody born 1960 or later, you have to wait to 67 for what they call full retirement age. But one of the things that's important to understand, that every year you delay taking your benefit up to age 70, your benefit when it starts will be higher. And usually what will happen is every year you delay, it will be about 8% higher if you wait a year, and then 8% higher the following year. So what that means is that if you were originally thinking about taking it at 62 and you wait to 70, your benefit will be significantly higher when you start at age 70. So we get the question a lot: should I wait? Should I not wait? And it really depends. You really kind of have to run the numbers. Everybody's situation is different, and people think about Social Security a little bit differently as well. Some people, the way they're thinking about it is, well, if I wait, how will that affect my net worth over the course of my life? And and part of it's going to depend on when you die and what you assume when you're going to die. Some people might be thinking, I've been paying into this my whole life. Um, you know, if I die at 68, I can't take it with me. So, there's different philosophies on this. There isn't necessarily a right answer, but there are ways to kind of analyze it. And there's no necessarily right way, but your financial advisor, if you have one, might be able to kind of give you different ways to think about it to try to figure out what's best for you. Now, when we talk about income planning, I don't know if any of you have heard of something called the 5% rule or the 4% rule or the 3% rule. What that basically means is your advisor says, well, I'm going to retire at age 65 as long as I'm using the 4% rule, as long as I take 4% of my assets or less, I should be fine. 5% rule is a little less conservative. 3% rule will be a little more conservative. So the question is, are these rules, do they always hold? And the answer is not necessarily. And the reason is because something we call sequence risk. Because what happens is your assets are moving up and down. And if you're taking money out at the wrong time, it can affect how long your assets last. And there are scenarios where if you don't manage your asset properly, you can run out of money in your lifetime, even if you're using some of these rules. And like we discussed, money behaves a little bit differently in what we're calling the distribution phase versus the accumulation phase. So that's why we say you want to be thinking about income. And there actually is some academic research that shows that some of these rules of thumb are a little bit of a myth because they don't always hold up. And there's been multiple reports from even places like Stanford, the American College of Finance was actually founded by I believe it was a Wharton professor a long time ago. There's a gentleman at the University of Toronto in Canada who is a very big retirement academic. So there's multiple research that kind of draws that conclusion. So important to kind of understand that. Now, I want to just kind of talk about this last topic as it relates to sequence risk. That's very, very important. Now, what I want to show here are two different scenarios. This is when we're in what we call the accumulation phase of retirement, which means we're probably in our 40s, accumulating into our 60s, and we're not touching our portfolio. Now, we're going to look at these two different graphs, the green and the blue. Both of these have the same return over a long period of time, but we got there different ways. What the green graphs basically suggests is that, when we started investing, we had some early down years, but market recovered and we were fine. The blue kind of suggested we got off to a really good start, but we had some rougher years later. Now, when we're not touching our money, it doesn't matter. We get to the same place. Now, if we're in retirement and we're in a situation where we're drawing out 5% a year, if our portfolio gets off to a great start and then kind of tanks towards the end, we'll still be fine, okay? But if you run that second scenario where we got off to a bad start and then the market recovers, we can run out of money prematurely because what will happen is we're withdrawing money in those early years while the market's down and our portfolio never got a chance to recover. That's why sequence risk matters. Now I'm going to show it one other way. If you think about the period from 2000, and I put up to 2022, if you invested $1 million in 2000, you'd have just under $4 million in 2022 if you didn't touch it, okay? However, if you retired in 2002 and your money was pretty much in equities and you were taking out 5% a year, you would have run out of money between 2012 and 2013. If you took out 5%, the red is actually 6%, the yellow is 5%, but in both cases, if you were withdrawing those rates, 5% or 6%, you would have run out of money if you were predominantly in equities. You know, if you were at basically the 4% number, you wouldn't have run out, but you would have exhausted most of your money. So very important that you understand sequence risk and the danger of positioning yourself too heavily in equities during the distribution phase versus when we're in the accumulation phase and we can live with that volatility because we're not touching our money and we're riding through that volatility. Now, just to wrap up, as it relates to retirement planning with your portfolio, very important not to put all your eggs in one basket and make sure you have a more diversified portfolio that can improve your risk-adjusted returns so you lower the probability and hopefully are not in a position where your money doesn't make it through your life and the life of your loved ones. So very important to consider diversification. And diversification can mean more than just basic stocks and bonds and cash. But for the most part, you want to be thinking very importantly about diversifying your portfolio for the retirement, what we call distribution phase. So concluding thoughts. Make sure you have a written retirement financial plan in place. So not just to address some of the income concerns we talked about as it relates to, will your money last with respect to your portfolio, but it addresses things like an estate plan. It addresses, how you're going to deal with long-term care, how it's going to address legacy issues, all those kinds of things. You want to make sure you think of your portfolio almost like a private pension. You want to plan for those gaps. And you never want to be too dependent on equities in retirement. And again, you want to kind of make sure you're planning for income to the extent that you need it. And you want to eliminate those unnecessary risks in your portfolio. So with that, I'm pretty much set. I hope that the crowd kind of picked something up, a nugget or two. And I'm happy to answer any questions if we have time, and if we don't have time, offline.
My apologies, I was on mute there. We did have a question here. Aren't you required to take some of your IRA out at a certain age? I'm thinking they're talking about RMDs, so you can Correct. Talk about that.
The answer is yes. It's RMDs. It's called required minimum distribution. There's a calculation, which I'm not going to basically go through how it's calculated, but there's an actual calculation that determines your required minimum distribution. It changes every year, so it's important to understand when you have an RMD, it's going to change every year. You need to, so basically, it's 72 is the year where you need to start taking required minimum distributions. unless you turn 72 after 12/31/22. So basically, if you turn 72 in 2023, you can wait until you're 73 to take your required minimum distribution.
Yeah, a little bit of a rule change from recent legislation. Yeah. All right. And then one more question. We did go a little bit over time. I hope if you have any more questions and we're not able to get to them, go ahead and put your contact information in the chat, and we're happy to, like David said, address those offline. So that graph that you put up about, the up and the down, it was the green and the red graph. How do you know if your timing is correct? How do you know, I mean, you can't have a crystal ball. Talk about that a little bit.
Very good question. So when you're thinking about retirement, you want to have a strategic plan which uses different asset classes which aren't necessarily all correlated to each other and don't all necessarily have the same volatility. You're right, timing the market is a loser's game, but there is a way to position your portfolio where you can improve your risk-adjusted returns and kind of more minimize your volatility so you can be in a position to get a return. As an example, in that period from 2000 to 2010, if you diversified your portfolio, if it was 100% in the S&P 500, you'd have no return. But if you added the right mix of international, small cap, bonds, you might have eked out a 4 or 5% return, and you might have been able to meet your retirement plan objectives. However, if you were 100% in the S&P 500, you would have had zero. So it's a question of creating those right mix so you increase your chance of winning.
All right. And then we did have one request to repeat that minimum distribution rule change one more time, please. And actually, I'm going to put in the chat a link that I found from the IRS. You can just Google RMD's IRS 2023. Can you repeat that again?
Yeah. So if you turned 72 in 2023, you can defer your required minimum distribution to your 73.
All right. Well, it's a good one to end on. Folks, we want to thank you so much for being here and for the organizations that have made this webinar possible today. Thank you, David, for being our instructor today. Really appreciate that. And I know there was a lot of information we covered today. So folks, we will be sending a link to the replay of this event, and you're welcome to share that with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you everyone for coming, and we hope to see you at another webinar very soon. See you, everyone. Bye-bye.